welcome to the 6th edition of the M.B.A. podcast series. My name is Jeanette Young. I am the C.M.T. program director here at the Market Technicians Association, and today I'm joined by Ed Carlson. Ed is the creator of the confirmation model and is an independent trader and consultant based in Seattle, Washington. He spent 20 years as a stockbroker. Ed's also a chartered market technician and holds an M.B.A. from Wichita State University. He manages technical analysis blog directed at financial advisors at fatechnicaladvisors.blogspot.com. Thank you for joining us today, Ed.
Well, good morning, Jeanette, and thank you.
Well, here in the East Coast, it's the afternoon, but it's a beautiful, crisp day here in New York.
Well, I wish I could say the same for Seattle today. It's overcast and a little gloomy, but if you live here, you got to get used to it.
Used to the gloom.
Used to the gloom.
Yeah, I see that you have an article coming out very shortly in SFO magazine.
Yes.
Stocks and Futures and Options magazine.
Stocks, Futures, and Options magazine. Correct. That'll be in the November issue.
And it's called "Should a Bollinger Band Break Be Bought or Sold?" Very interesting abstract that you've written here about something you have named the Carlson confirmation model. Could you tell us a little bit about how did you come to this idea and what it's about?
Well, I'd love to, of course. I wanted to say first that this whole stockbroker is just totally flattered and even honored to be part of the podcast series you're doing, to be included with names like Ralph Acampora and Cynthia Case. It's just, it's a real, well, as we say, I used to say in the brokerage business, you made my month. But to shoot right to the chase, the inspiration for the model, it goes back several years. To when I first started studying for the C.M.T, actually, the Chartered Market Technician designation. The author, and I don't remember which book this was, but the author of one of the books on the required reading list had written somewhere in that book that a decrease in volatility is always followed by an increase. And at the time, my initial reaction was, you think? But the funny thing was, over the years, I could never get that out of my mind. In those quiet moments, that's one of those things that just kept coming back. In life, there's very little we know for certain, and that goes double for the financial markets. I remember last May that you and I were both at the symposium, the M.T.A. symposium there in New York at the Bloomberg building. And I'm sure there's several things you remember from that, but something that stuck in my mind was during the presentation that Robert Prechter gave. He set out to differentiate the markets, or the certainty versus the uncertainty between the normal markets that people normally think about, the market for goods and services, which he explained or objectively said that it was supply versus demand. When price goes up, demand falls. And then he compared that to the financial markets and illustrated how they work just the opposite of what you would normally expect a normal market how to function. That when prices rise, demand for financial instruments rises as well. And we can see that in the positive correlation between market prices and volume, as well as market prices and the stocks held as a percentage of household assets, which, if anyone's interested in that, they can find that at the St. Louis Federal Reserve site. That's a real gold mine.
Oh, my God. Is that a wonderful site for really great information and articles? I enjoy reading some of their articles.
Yeah. So anyway, whereas the markets for goods and services are rationally set in a context of certainty, the market for financial assets are irrationally determined. I'm trying to paraphrase what he said here. And it's not what they're worth, but rather what will the next investor be willing to pay for those assets, certainly a context of uncertainty. So to kind of bring it full circle, I came to believe that this author's observation of the obvious might be the rock or touchstone upon which a trading approach could be based. Mm-hmm. And that was kind of the inspiration for the whole thing.
So you just wrote this recently? It's an offshoot of the May Symposium?
No. I mentioned the May Symposium because I thought it was a good illustration of.
But it is a good measure of bubbles and troughs. Mm-hmm. Would it not be?
Yeah, sure.
So
Absolutely.
let's go on and explain to the listeners what exactly you're doing here.
Okay. Well, it's going to be hard to get into too much detail, but on an audio presentation. But I think the best place to start is what is the hypothesis of this model? Not to use too big of words, but to be as succinct as possible, the basic hypothesis of the confirmation model is that just as day follows night and low volatility is followed by an increase in volatility, that the dominant trend is correlated with an increase in volatility. The dominant trend is correlated with an increase in volatility. Now, I'm sure there's someone out there with a spreadsheet who can prove this hypothesis incorrect. It's just statistics 101. We can never really prove anything. We only disprove a hypothesis.
It makes sense. If something is going in a direction and the neighbor sees it going that way and they're saying, hey, gee, why don't I get a piece of that too? And they jump in, and that's just human behavior.
That's right. That's exactly right. So I guess the bottom line here is a statement like this is somewhat similar to saying we hold these truths to be self-evident, or I think, therefore I am. We've got to start somewhere.
Within parentheses for the most part.
Yeah. So anyway, it seemed like an easy way to track whether volatility was expanding or contracting would be just to follow Bollinger Bands and see if they were expanding or contracting. So I created a real simple indicator called the bandwidth indicator, or I called it the bandwidth indicator. I probably should mention that John Bollinger's got his own bandwidth indicator, and it has nothing to do with this. And
by the way, Bollinger Bands are a measure of two standard deviations over a set moving average. Moving average is something that you can change, and I think the default rates are 20 or 21, I'm not sure. But that's what the Bollinger Band is, just for those who don't know what it is.
The Bollinger Band is, I think the power in those things is intuitively obvious even to the novice technician, but the problem also becomes, in using them to manage money, becomes obvious very quickly to anybody that tries to manage money with them. On one hand, Bollinger Bands are used to trade the reversion to the mean concept, but they're also said to be used to determine breakouts. Every book I've read on this talks about the two uses, but it always leaves the analyst or the user to determine for him or herself when it's best to use bands for which indication. The beauty of the model is that it differentiates between when to use Bollinger Bands for reversion to the mean versus when to use them for breakouts by looking for confirmation between relative strength and the bandwidth indicator.
Which leads us right into your indicator.
Yeah. If a person can visualize this, when I set up a chart, in addition to price, I've got three indicators. And so, for example, in the top window, I use the 3-day relative strength index, which maybe I should just, as a reminder, this is Wells-Wilder's RSI and not relative strength, okay? It's how is that indicator or that asset moving in relation to itself and not relation to any other asset. So the top window, I've got the 3-day relative strength index. Second window, I've got price. Third window, I've got the 14-day relative strength index. And in the bottom window, I've got this bandwidth indicator. Now, I want to interject here that this bandwidth indicator is very simple. It's something I created. It's easily reproduced. No one should shy away from attempting to use the model because of the need to recreate this indicator. I've only had one computer programming course in my life, and that's back when we were using punch cards. So you can imagine my level of knowledge about programming computers. I actually called my software provider, and they wrote it for me. And when I saw it, even I was embarrassed that I'd asked them to do it for me.
I feel your pain.
Well, yeah. So to conclude chart construction, the model then, we overlay Bollinger Bands on both the 14-day relative strength index and on the bandwidth indicator. Okay, and I'm just using the standard 20-day moving average and two standard deviations, as you mentioned before. But this bandwidth indicator, it's really the heart of the model. That in addition to a few rules I've set up. And just remember, the bandwidth indicator measures the distance between the RSI Bollinger Bands. So as those bands are expanding on RSI, the indicator goes up, and vice versa. The theory is that volatility increases, bands are expanding, as the RSI and price are trending. And volatility decreases, that is, the bands are narrowing, as the RSI and price are moving against the dominant trend, okay? We're trying to find what is the dominant trend inside all this noise. And by creating an indicator, the bandwidth indicator, that advances as the bands widen and declines as they narrow, then we can visually determine whether the movement in the underlying asset is moving with the dominant trend or against it. And then we add on this rules-based methodology that I've created, and the model then reveals whether an expansion in volatility is going to be associated with an advancing or declining prices, and tells us as soon as the price has been made. And frankly, the exciting part about this is it often tells us prior to a turning price. And if anybody's wondering, that's why I put the Bollinger Bands on RSI rather than price, because the signals come faster.
Well, that's because most oscillators and most signals from models like this are always lagging the market. It's fabulous to see something that is ahead of the market and kind of tells you to watch out.
Well, that's what gets me so excited about it, and that's why I'm so eager to share it with everyone today.
Well, we thank you for doing that. So let's go on. Let's go to our triggers here.
Okay.
This is fascinating.
Well, good. I hope everyone else thinks so as well. The triggers come from the RSI, and you're looking for, obviously, buy triggers and sell triggers. But unlike most uses of RSI, where if you see RSI, let's say, oversold, and some people define oversold by being under 30, others, myself included, usually would define oversold RSI as being under a lower Bollinger Band. None of this makes any difference if the bandwidth indicator is not in a buy mode. The bandwidth indicator, we've set up different modes, buy and sell modes, and those tell us whether to be looking for buy or sell triggers with the RSI. Mm-hmm. Frankly, at this point, it gets a little deep as far as trying to illustrate this without charts.
So what you're saying, basically, so long as the Bollinger Band is continuing to point lower, it can be assumed that we are getting bearishly oversold, but bearishly. So we haven't gotten a buy signal as yet because we're still pointing lower, and we still are saying that we could go lower.
Okay, you're talking about in a bear market, right?
Yeah, or in a bull market would be pointing above and going higher and just showing you that it can continue to go higher. So you can call it bullishly overbought, which means you don't sell it because you're still bullish.
Right, exactly. And then to add on to what you just said, one of my rules is that even, let's say you've had a buy signal, and actually let's just go through a real simple buy signal. Okay, so let's say we're on a sell signal, and so we're looking for a change to a buy signal. Well, I don't think I mentioned that the bandwidth indicator, I've also got Bollinger Band set up on that. And if the bandwidth indicator were to drop so far that it would drop below its own Bollinger Band, that then is a change of mode, and in this case that would be to the buy signal. At that point, we'd be looking for a buy trigger from the relative strength index, and let's not go there right now.
Okay.
But then as the asset started to trend, in this case, we're assuming it's going to trend upwards because we're on a buy signal. Let's say we got our buy trigger. Then at some point, that bandwidth indicator may actually get above its own Bollinger Band. So now it's gone from below, which was a change of mode, to a buy signal, buy mode, to above the upper Bollinger Band, which I call a confirmation of the signal. And at some point, that bandwidth indicator is going to start to curl over. All right. Mm-hmm. Well, two rules actually. One is don't even think about selling your asset until it starts to curl over. Okay, no matter what happens with the asset price. And number two is just because it does curl over, and obviously that means the relative strength Bollinger Bands are starting to narrow, that in itself is not a sign to sell either. So that's one simple illustration of how this works. What I would say, if someone's interested in learning more about this, take a look at that SFO article that unfortunately won't be out until November. Or if they don't even want to go to that point,
they could email you and you would be happy.
They could email me. I'm at carlsoned@comcast.net, or they can go to my blog and just follow the signals that I'm giving there.
Okay. Again, repeat your email address for everybody.
Thank you. Carlson Ed, it's all one word, carlsoned@comcast.net. Or, as you mentioned, the blog is fatechnicaladvisor.blogspot.com.
Okay, and FA Technical Advisor is all one word.
Yes.
And Blogspot is one word, and there are dots in between.
And there are dots in between.
Okay.
Yeah.
On to the rules. So I have this rule here: if the mode changes to buy, you're drawing an anti-trend line. Would you like to discuss that and talk about that for a second?
Oh boy, I guess
sorry.
We can go there for a second.
But it's there.
Huh?
But it's there.
But it's there. There's a lot of things that are there. I just think I'm worried that it's going to be very difficult.
So where are you drawing your trend line from, and why do you call it an anti-trend line?
Well, because this goes back to the triggers. Okay, and for the listener's sake, we're talking about trend lines on relative strength, not price. All right. So let's say that bandwidth indicator dropped below the lower Bollinger Band, and we're now on a buy signal. Well, chances are that relative strength indicator has been trending down. So now what we're looking for is a break of that declining trend line in relative strength. So at this point, we have to go back and we determine a trend in RSI, the declining trend, and now the trigger would be for RSI to break that declining trend to the upside. That would be our buy trigger in this case.
Oh, by the way, for the listeners, you do not need 3 points to draw a trend line on the RSI. You only need 2.
Oh, that's interesting. Now, where'd that come from?
It came from your chart. I looked at it.
Oh,
some of them you have 3, but most of them you have 2, because this is not the price. Actually, the entire chart, there isn't one line on it, because we're talking about something quite different. So you can, for the listeners' sake, you can all ignore the chart right now, the price chart, and just stare at that RSI with Bollinger Bands on it, and the Bollinger Bands on the Bollinger Bands.
And the Bollinger Bands on the Bollinger Bands. No, Bollinger Bands on RSI and Bollinger Bands on the bandwidth indicator.
On the bandwidth indicator, sorry.
Right.
Well, at least we clarified it.
We'll finish this part of our discussion by I wanted to mention the 3-day relative strength indicator. A lot of index, excuse me. A lot of people have never even heard of using this. I think it's a real gem, frankly. What I use it for 2 things. I use it to buck me up, give me a little confidence. If I'm looking at, say, a buy signal that I'm just scratching my head over and thinking, how can that be? I'll take a look at that 3-day relative strength, and what I've found is that if the dominant trend is up, that 3-day relative strength should be able to get over 80, right? And it should not be dipping under 20, and vice versa for a sell signal. And so if I see that it's getting up over 80, or at least staying in the top half of its range, it gives me that little added bit of confidence that I need to go from just talking about this to actually pulling the trigger on a trade. I was going to say something. What else was I going to say? Oh, and it can also serve as a warning. If RSI is not able to act like I would think it should under the signal I'm getting from the model, then I might just pull back and be a little more patient than I would otherwise. So while the 3-day RSI is not really a part of the model, it's my own confidence builder or warning signal. And
right.
I think everybody appreciates having something like that.
Hey, folks, you've got to read this article. Go to the article when it comes out in November and read it, or email Ed. But I think you should read the article. It is really, really interesting. I'm going to ask you one more question, and then we're going to put an end to this.
Okay.
Have you thought about combining a 3-day RSI with a 14-day RSI and putting a Bollinger Band on that?
Yes, but I didn't spend a whole lot of time on it. I took a look at it, and I decided that I think the 80-20 rule is probably going to be as much as I can get out of this thing without driving myself crazy.
I know. You decided the right thing to do is to keep it simple.
There you go. That
All
really
right.
is the right thing to do.
It probably is. This is a fascinating topic and a very, very fascinating indicator, and I am so glad that you spent the time explaining it to us, and we look forward to seeing this in SFO Magazine in the November issue. Thank you, Ed, for appearing here on the MTA podcast with me today.
Thank you, Jeanette. I enjoyed it.
And have a very wonderful trading day.
You too.
Bye.
Bye.